Okay, I think we are more or less ready to begin. Thank you, everybody, and welcome for joining. Welcome to our webinar today. My name is Bridget Bull. I will be hosting the webinar today and asking our esteemed panelists some questions. We thank you all for joining us and for being part of the webinar today. A few bits of housekeeping. The basic format for today, we will be, Caroline's going to give us a presentation and then we'll have a panel discussion from all of our panelists that are here today, and I'll introduce you to them in a minute. But I also would like you to ask Q&A as and when we go along. So there's a Q&A function at the bottom of your screen. You're welcome to ask Q&A through that medium, and we will try and pick up as many of them as possible. Sometimes it's not possible to get them all, but we'll try and pick up as many of them as possible through the panelists. We will also have some of our great team members answering some of them as we go, who have a lot of insight into the report itself and into a lot of the detail of what we've been talking about. So feel free to ask those questions as we go along. A quick note on the report before I hand over and introduce the panelists. This report is now, the State of the Market report is now in its 12th iteration. So we have been doing this report for many, many years. I was actually involved in the very first one and some of the early ones. And while the message has changed over the years, the market has grown a huge amount. I still like to think there's something in this report for those who are new and those who are old to this market. So there's a huge amount of detail for those who want to delve into the depths of dissecting the market this way and that. And there is also a lot of basics for those who are new to the market. So I think there's always something in this report for everyone who is new and very accustomed to the market. And I hope you enjoy reading it. And Caroline will also take us through the report in a bit. I would like to introduce you in a moment to our panelists. We have Vivek Pathak from the IFC, who's going to give us an introduction in a little bit, and we welcome him. Thank you so much, Vivek, for being part of this discussion today. Markus Stix from Austrian Treasury, he'll be talking about some of the sovereign issuance from Austria, which was very exciting, and we'll be talking about that in a bit. And we have Philip Brown from Citi, who many of you might have seen his face before, and he's an old friend of client bonds. He's going to give us his view on some of what's been happening on the market and the temperature. And Camilla Silva, who is from La Green Fund, who will give us some of the investor perspective and some of the very important perspective from Latin America. So we thank you so much for being on the webinar today. And then, of course, last but not least, my esteemed colleague, Caroline Harrison, who has written the report with the help of our colleagues, and she'll take us through the report as well. So Vivek, I think I'll hand over to you. I know you're going to give us a bit of an introduction to get us started today, and then I'll hand over to Caroline. Thanks, Vivek.
Yeah, thank you so much, Bridget, and a very, very good morning, good afternoon, good evening to all of you all, whichever part of the world you're in. We're having a beautiful day in Washington, D.C. today, so I'm quite trying to be brief. This is a really important report because, especially for emerging markets, what we are trying to do in emerging markets is to direct more and more capital towards these capital market instruments. And it's an exercise that IFC started, and I was personally involved in when we did our first green bond in 2015 or maybe 2016 in the Philippines. And at that point in time, most banks, when we used to talk to them, they said, green bond, yes. Is it cheaper? If the answer is no, and involves a little more work, please don't bother us. And it sort of is really interesting to know that the Philippines market, where we did a few of our first green bonds, both in banks and energy companies today, I think almost a $3 billion a year market there. So that shows that these markets are developing. Last year, I'm hoping, was a bit of a blip. We had almost a 20% decline in green bond issuances. But the good news is, I think sometimes these dips are good, but the overall trajectory remains to be very, very positive here. Three things that I want to focus on. One is the importance of greenwashing. I think as a market grows, there's going to be a lot more scrutiny on this market. And I think it's collectively our responsibility, both as MDBs like ourselves, as institutions like the CBI, as issuers like Marcus at Citibank, for all of us to collectively get a little more stringent if need be. I would rather err on the side of caution And as this market has expanded and we've had sustainability-linked bonds, I think that's where sort of the boundaries are getting a little blurred sometimes. So I really think we need to ensure that we don't have any accidents, because once you've had a problem, then the entire market is sometimes scarred with that. Yeah. The other thing that's quite evident, and that's where we are doing a lot of work at the IFC, is on the supply side. I think there is substantial demand. There is capital out there. And, when the world says that we need $1 trillion and we don't have it, my argument is the opposite, is I think money will come. I'm not worried about capital coming. Is we need to make sure that we have good, robust, well-structured companies, projects that can issue green bonds or transition bonds here. And I think it's important that we get the conversation on transition bonds going a lot faster, because that's really how companies are going to transition. I mean, a green bond, I think we've done it. We know how to do it. We'll definitely do a lot more, but transition bonds is an area that we in IFC are very focused on. And the last thing I want to say, which is another favorite of mine, is a lot of focus is on cross-border capital flows. But I really think if you're going to solve the climate challenge, we also need to start linking domestic savings and domestic capital to climate. And therefore, the importance of developing domestic capital markets is going to be absolutely critical. And the reason for that is quite simple on a number of accounts. Firstly, I think every time you have cross-border flows, the country is taking currency risk unless and until that particular project is export-oriented. So how are countries going to pay back all this foreign currency debt? Well, I can tell you that a number of countries are getting more and more worried. Second is there are pools of capital within a country, and I see no reason why those pools of capital should not be going into climate. So if we can go and attract, say, the Canadian pension fund to invest in climate in India or in Vietnam, why not the Indian and the Vietnamese pension funds investing in climate? And I think capital markets will be the conduit through which this will happen. Yeah. So with that, I really want to thank you all for all your support, and we really hope this partnership will continue. So back to you, Bridget. Thank you very much.
Thank you so much, Vivek. You raised excellent points and in a very succinct manner. So thank you so much for that. Very useful points. And I think we're going to be touching on a lot of those today. Greenwashing, we're going to be talking about some of the instruments you mentioned. And so I think that's really important. Similarly with transition, it's a big focus of today as well. So thank you so much for that intro. And we look forward to the partnership as we go forward. Caroline, I'm going to hand over to you to take us through a very kind of short highlights package of the report. As many of you know, it's impossible to summarize the whole thing unless we carried on this webinar for many hours to come. So I'll hand over to you for the highlights package, and then we'll get into the discussion.
Thanks, Bridget, and thanks, Vivek, as well. It was interesting to hear some of the points that you raised, because I'm going to be talking about exactly those points as I go through this presentation. So hello and welcome, everybody. I am Caroline Harrison. I'm the Head of Markets Intelligence Research at Climate Bonds, and together with my colleagues, I have worked to produce this research report, which was published today, and which you can download from our website. So when we talk about GSS+, we include the 5 themes of green, social, sustainability, sustainability linked, and transition bonds, all of which are included in our analysis of the sustainable debt market. By the end of 2022, cumulative GSS+ volumes recorded by climate bonds had reached $3.7 trillion, with the green theme being the largest, contributing $2.2 trillion. In 2022, climate bonds captured $858.5 billion of new GSS+ volume. So as Vivek's already noted, that was a 24% decline year on year, although GSS+ debt maintained its contribution of 5% to overall market volumes. Reflecting the overall market share, the green theme continued to dominate in 2022, responsible for 49% of the volumes priced last year. The transition label was the only one to exhibit growth by 5% on the year, albeit from a small base, but the number of issuers in that market tripled, and this can be linked to the policy support received from Japan and China. So the year started strong with GSS Plus volume in January reaching around 120 billion, just under, which was 88% more than the 62 billion priced in 2021 January. But the Russian invasion of Ukraine, which happened towards the end of February, saw issuers of all types of bonds taking deals off the table and starting to step back from the markets. The resulting energy price spikes and the rising inflation led to a drop-off in issuance volumes almost everywhere. So what was the source of GSS Plus debt in 2022? Well, supranational issuers dominated the top 10 sources that you can see on this slide, with 115 or close to 116 billion actually in volumes across the three major use of proceeds categories. The USA was the largest country source and priced the highest share of sustainability debt among the countries. France was top in social bond issuance, and Italy led the way in SLBs. Meanwhile, $1.9 billion, which doesn't sound a lot, but is big in a small market, $1.9 billion US dollars of transition bonds originated from Japan. So not shown on this chart or any chart in this presentation actually, but worth noting is that 42% of the volumes were issued in euros and 29% came in US dollars. So those continue to be the dominant currencies in this market. So at Climate Bonds, we closely monitor changes in GSS Plus sovereign debt because of the huge power and influence wielded by this issuer type and its potential to lead markets both internationally and locally. So by the end of 22, Climate Bonds had recorded GSS Plus volumes of 320.4 billion US dollars altogether, 81% of which is the green theme, and debt had come from 43 issuers by the end of last year. So 6 sovereigns priced debut green bonds, all developed markets. Austria represented on our panel, Canada, Denmark, New Zealand, Singapore and Switzerland. The Philippines, again, already referenced by Vivek, was the only debut issuer in the sovereign sustainability bond space. So in the report, we highlight 3 developments that extended the sovereign GSS Plus market in 2022. Firstly, Austria priced the first short-dated or the first green money market instrument, which I'm sure Marcus will elaborate on in a second. Hong Kong SAR and France both came to the market with inflation-linked deals. And finally, Chile and Uruguay priced the first sovereign SLBs. So just, you know, an interesting factoid. Among the 43 sovereign issuers that have been recorded by Climate Bonds, Chile is the only one to have issued green, social, sustainability and sustainability-linked bonds. So increasing the variety of structures is hugely important in the sovereign market. You know, it can enable more issuers to use GSS Plus labels, and because the investable opportunity set is increased, it will attract more sources of capital. So we have highlighted 5 themes which we believe will propel the market forwards in 2023. And I think these are going to form the basis for the panel discussion after this. So I'll just briefly go over them. First of all, resilience. Climate Bonds is committed to supporting the development of clear rules and definitions for this market, so that the current universe of green investments can be extended to include those that build and contribute to resilience. There's a section in the report which examines what has been priced so far, and we explore the potential for this market. So that is, you know, sort of a separate chapter, if you like, in the paper, and probably worth reading. Secondly, the SLB theme emerged in 2018, but concerns have continually been raised around the legitimacy of the ambition of some of the deals. Don't panic, Climate Bonds is already on top of that, and we have just announced that we have extended the Climate Bond Standard and Certification Scheme to include SLBs. And in 2023, we are looking for the first Climate Bonds certified SLB to come to the market, and that will hopefully enable the market to really sort of take off, grow rapidly and with credibility, and contribute meaningfully to our goal of the annual 5 trillion in thematic debt. So thirdly, government support for green industry will likely accelerate in 2023 with subsidies, guarantees, tax offsets and other financial incentives to underpin discoveries that enable the rapid scaling up of climate change solutions through large transparent deals bearing thematic labels. So we expect to see this develop through IRA bills in the US and the Green Deal Industrial Plan for Europe and others around the world. Fourth, Climate Bonds expects to see more transition instruments in 2023 as entities operating in the hard to abate sectors try to align with global efforts towards net zero. Climate Bonds again is attempting to support this with the development of new criteria that are appropriate for those industries, and, you know, basic guidelines on transition finance that have been published in both China and Japan have underpinned the growth in the market. And if other nations adopted similar frameworks, we could see a tipping point this year, we would expect. So finally, sovereigns must continue to use their power and influence in the sustainable debt market by continuing to issue deals and introduce new and innovative applications. Climate Bonds expects the number of sovereigns issuing GSS Plus deals to reach 50 in 2023, which is very achievable. We're already at 43 at the end of 22, and India, Israel and Sharjah have already joined the market in the first quarter. So we're well on the way to seeing that target realised. So finally, to learn more about these and other topics, you can find the report on our website, and I will pass back to Bridget, who will lead the discussion with the other panel members. Thank you.
Thank you, Caroline, and thank you for that. That gives us an excellent insight into kind of how the market's developed during 2022, and and a bit of an overview of all the different ways that the report looks at the market. I want to start perhaps with Philip to give us a kind of read on, we've seen the facts and we've seen the figures, which I think have been really useful in getting a sense of the market. We know the market dropped off a little bit, but it'd be good to get a sense from your view, kind of the temperature of the market, what you're seeing, and how the market, you know, developed in 2022 and how we see things at this point in time in 2023 and how things are moving forward as well.
Great. Well, thank you very much, Bridget, and thank you to Climate Bonds for inviting me to join you today for the publication of this great report. I think, you know, either way we slice and dice this market, it's clearly in great shape. I mean, it's a very substantial part of the capital markets today. And, you know, overall issuance volumes were down last year. Last year was a very difficult year for fixed income markets, clearly with the Russia invasion of Ukraine and the inflation that followed was clearly a very bad experience for bond markets overall. And I think as green bonds are somehow representative of the market overall, we saw issuance come off. But there are many ways of looking at the market. If I look at just dollars and euros, and the international issuance, taking domestic issuance away, then I think in 21 we saw GSS plus transactions as representing 14% of the market, and last year it grew to 16% of the market. So, the markets overall have been through a difficult time in 21, but nevertheless, 22, sorry, but the share of ESG labeled debt is increasing. And if we were to narrow in even further to Europe and euro-denominated investment grade debt, which is a very big part of the market. I mean, it's extraordinary to see that if we narrow that even further from investment grades just to corporate issuance, 36% of euro-denominated investment grade corporate issuance last year carried an ESG label. It's remarkable. I think one of the things to also highlight is that of all the different labels that we have with green and social and SLB and sustainability, green is the dominant label, and green continues to dominate. And I think, we talk a lot about SLBs, and it's great to see Climate Bonds Initiative coming out with your own standards for SLBs and so on, but that market is struggling to take off, quite honestly. I mean, we had, if I saw 2022, SLBs represented 11% of total issuance. 21 it represented, I'm right, 11% of issuance. If I look at 23 year to date, we're only 5%. If we talk, it still represents only 6% of outstandings. And maybe we'll come on and talk about this, but I think a lot of issuers are being asked a lot by the investor community of SLBs. And I think there's a feeling among the issuer community that the investors are not necessarily rewarding them for the commitments that they're making within the SLB structure. But, I think the market's in great shape. And if we talk of, how has 23 started, Q1 was fantastic. So we saw record volume. I mean, it was a record quarter Q1, particularly January and February, when, bond market conditions were tremendous. I mean, we saw inflation starting to come down. People were starting to anticipate the end of the hiking cycle from central banks. But then, of course, March, we hit this roadblock, a macro roadblock of the trouble with financial institutions, with the US regional banks, with Credit Suisse and so on. And that actually caused all capital markets to just hit a roadblock. All issuance stopped. I mean, it was absolutely remarkable that we went through a 2-week period. I don't think I've ever seen a 2-week period in March, such as the one this year, where we saw no issuance in any asset class whatsoever. It was remarkable. But this market is in great shape. I think we're continuing to grow.
Thanks, Philip. Yeah, I think that gives us a good overview, and I like that it's in great shape. And I think that is the key message here, is that the market has grown a huge amount. I mean, in the 12 years I've been doing this we've been doing this report, it's completely not recognizable. But even in the last 3 years, I think things have grown hugely. We are going to come on to the topic of SLBs, and I would like to touch on that in a minute. But before we go into that, I maybe want to think about the role of sovereigns and touch on the kind of experience from Austria. Marcus, we see Caroline has called sovereigns the jewel in the crown. So you are now the jewel in the crown, which I think hopefully you're very excited about, of the market. So as the jewel in the crown of the market, and be interesting to hear your experience as a sovereign issuer, particularly interested in hearing about, most green issuances have been on the longer end of the curve. And this was different for the Austrian deal. So I want to hear about that and your views on this topic and why it's important. Maybe a lot of our listeners might not, and viewers here might not know kind of the importance of this deal and also the importance of the role of sovereigns. So it would be great if you can comment on that.
Yes, sure. Thanks a lot for the invitation from Climate Bond Initiative, and as well called the sovereigns as the jewel in the crown. So we feel really honored. And to be honest, it is very important that the sovereigns and the issues are really part of this instrument, because it's like an important catalyst for the development of these capital markets. They are reliable and large issuers, and they can speed up and step up the market for all the investors. They are growing and growing, and you see a lot of demand, but from a supply side, due to the fact that it's really a lot of work for all the sovereigns to set up the working group, to align all the ministries together and all the agencies which you need for all the calculations. It's not an easy thing if you look at the different orientations from ministries to align them all together, but at the end it is really worth. And if you look at the transactions, and we entered yesterday with a 6-year benchmark transaction in the green format, a perfect transaction from our perspective, where the investors as well are committed and pay some premium for all the work the sovereigns do in preparing a framework ring fence out of a budget from Republic of Austria. We have 1,850 pages on balance sheet, and we dig through it, earmark all this for the community, that there is a wonderful framework where they can look through, and with a second party opinion provider authorize and approve all the projects that are included, that there should not be a greenwashing. That's very important. And at the end, you receive for the investor community a perfect report on the one allocation wise, but as well impact wise. So the sovereigns are very important to speed up this process. As Philip mentioned, the green is the biggest part within all the products, and you be like a role model and to help other companies in the country, in Austria, and as well on the sub-sovereign area, to follow the approach from the government. That's, I think, so important that the jewel of the crown is part of the game here.
Thank you, Marcus. Yes, I do agree. There's a hugely important role for sovereigns, and we've been talking about that for some time and been very encouraged by the growth in the market over the last, quite a small period of time compared to the growth of the market generally. We only saw the first sovereign issues a few years ago, and that's become a very important part of the market. So I've seen there's a question in the chat about sustainability linked bonds. So perhaps I won't delay us delving into this topic any longer, because I know that a lot of people are quite keen on chatting about sustainability linked issuances. And I kind of maybe picking up on some of Vivek's comments around the growth of the transition part of the market. And I would also encourage us to remember that sustainability linked transactions are part of this kind of transition market. If we think about the opportunity for sustainability linked transactions to demonstrate a transition over time and the importance of that instrument. But it is facing some headwinds, Caroline mentioned and Philip has mentioned as well. So Camilla, it'd be really interesting to hear your investor view on why that's the case. And then maybe we can discuss a little bit about how we overcome some of those headwinds as well.
Thank you, Bridget. And thanks a lot for CVI for the invitation to join this panel. Indeed, the SLB market is a relatively new segment of the sustainable finance market, having emerged in 2019, whereas the green bond market has been in existence since 2007. As such, the SLB market is still smaller than the green bond market, but is growing rapidly and is expected to continue to gain traction as more issuers and more investors seek to support a broader set of sustainability objectives. Some of the incentives of issuers of SLBs over use of proceed bonds as we know them include, for example, the flexibility. So unlike the use of proceed bonds, which are linked to specific projects or assets, the SLBs are linked to a broader set of sustainability objectives, such as greenhouse gas emissions reduction, for example, or social impact or biodiversity conservation. These provide issuers with greater flexibility in how they can use the proceeds for the bond and can help them to achieve a wider range of sustainability goals. Also, the SLBs can be easier and faster to issue than the use of proceed bonds because they do not require the issuer to identify and allocate specific projects or assets to back the bond. This can help issuers to quickly access capital and raise funds for sustainability initiatives. And also what I have seen is that there is a growing demand from investors for sustainable investments, and SLBs can be an attractive option for those who are looking to support a broader set of sustainability objectives. This can help issuers to tap into a larger pool of capital and potentially achieve a more favorable environment in terms of the bond. However, while the SLB market has grown in size and in popularity, there is certainly room for improvement when it comes to the rigor of the market. I've seen some controversial transactions that have like frequent, like some commonalities. So for example, I've seen SLBs with immaterial KPIs. That means that they have indicators that are irrelevant to the issuer's business or do not deliver any relevant environmental or social additionality. Also, some of them have had unambitious targets. So our targets that are very easily reached when compared to issuer's baseline or to the peer performance. And then there is also a challenge in measuring the impact that was established. So KPIs and targets are very difficult to be measured. I think that to address these challenges, it's important for regulators, for investors, and for issuers to work together to establish clear guidelines and standards for SLBs. This could include, for example, the development of standardized reporting frameworks, the establishment of independent verification and certification processes, and the creation of industry-wide benchmarks for measuring the effectiveness of SLBs. Here, as mentioned by Caroline at the beginning of the panel, I think the fourth version of climate bond standard is going to be crucial. In addition, I think that the right selection of relevant KPIs used in sustainability-linked transactions is one of the key aspects to guarantee a strong and robust transaction. The KPIs need to be relevant for the company's core business, but also for the society. And I think also all KPIs require a sustainability performance target related to it. So after defining the KPIs to use, it's important to determine which are the targets to be reached and also which are the baseline for comparison. Overall, I believe that the SLB market has an enormous potential to drive positive social and environmental outcomes, but it will require a continued collaboration and innovation from all different stakeholders to ensure that it lives up to its promise.
Thanks very much. Yeah, I totally agree with you on some of the big stumbling blocks. As you say, not material KPIs, not ambitious, and some of the challenges with measurements is something we're seeing across the board. Philip, I'd be interested to hear if that kind of concurs with your view and what you're seeing on the SLB space as well.
I'm not sure that it does necessarily. I think that you captured it well when you think about SLBs in the context of transition. And I think SLBs are an instrument that are perhaps very well suited to issuers who are transitioning. And I think one of the challenges the market has so far is that many investors, as they're being encouraged by regulation everywhere to define what they have within green, in Europe, the term green is becoming a highly regulated context now, and we have the establishment of Article 8, Article 9 funds and so on. And I think there's a degree of uncertainty in the minds of issuers where transition sits within a green portfolio. I think a lot of people think about green, when they think about green, they think of low carbon. They don't think about the journey. They think about the issuers who've already got there. They think about the low carbon assets. They think about emissions avoided. It's easy to understand, I think, the increasing, the background to the increasing popularity of use of proceeds green bonds is that it's a very straightforward for investors to think about where they can allocate these instruments within their ESG portfolios to meet the ESG needs of their asset owners. And I think it's not quite so clear where SLBs fit into this picture. I think Camilla has also nailed it with regard to the complexity of reporting. I mean, I think we've seen over the last 12 months the increasing levels of sophistication of all stakeholders, and I think everybody is becoming more demanding. And with SLBs, I think there's an understanding from the market now that if Scope 3 emissions represent more than 40% of your total emissions, then you must have a Scope 3 KPI. It's very difficult to measure Scope 3 emissions, and it's very difficult to have a historic baseline which you can accurately refer to as a benchmark against which your future emission reductions can be measured. And I think that is in itself very complicated. And finally, I would say that many issuers support the idea of being ambitious, but they feel that they are not rewarded by the investor community by a reduction in their funding cost for all of the work that Mr. Sticks referred to, a lot of work that needs to be done to prepare to issue a green bond. With an SLB is arguably an even bigger commitment. And they don't necessarily, I think investors, there's a feeling among the issuer community that investors view SLBs almost as an unlabeled bond. There is an ESG covenant in there, which is nice to have, but investors will not pay for it. And so I think that's an obstacle we need to see overcome. This very interesting transaction from Uruguay last year with the step down as well as a step up. But I think this is something that the market needs to think about how to reward investors for the issuers for the commitment that they're making within their KPIs.
Yeah, I mean, it's a really challenging issue, and as you have already pointed out, the when we've gone into kind of more transition type of sectors and they're more kind of hard to abate, difficult. This is a difficult area, technically challenging. They're already called hard to abate. It's the kind of sticky end of the. I like to think of it as green transition. So we know that a lot of this could fall under green, but the degree of comfort around the sectors is a big part of the challenge. We know that there are a lot of sectors that are also, most sectors are in transition, but some are better understood by investors than others. Buildings is a classic one where investors understand that, easily put buildings that are nowhere near low, zero carbon and today, but are moving in that direction. And so that's kind of an interesting, it's when we get into these less understood sectors and more harder to abate sectors, that's where kind of a lot more guidance from the market and some of the work we're trying to do in providing that is hopefully going to lower the barriers to entry for those sectors. But I guess we'll see how that all pans out. And it's an interesting and challenging space, but one we desperately need to get finance to move forwards in a kind of ambitious way. I'm interested as well. I mean, we haven't SLBs when it comes to, you mentioned a few deals already. SLBs when it comes to the sovereign space is quite a different challenge, and quite a different set of issues we're looking at. I know, Marcus, you didn't look at this format for Austria, but I don't know if you had any views on this as a kind of particular challenge for sovereigns. It's a kind of becomes a lot more complex, or perhaps Philip, you also wanted to add your views.
Yes, definitely. From an Austrian perspective, if you look at our share on the Eurozone market, it reflects only 4%. And therefore, for us, it is very important we have a two-pillar strategy. The one is the conventional product, and the second one is the green one. If we would go further with different or additional programs like SLB or inflation link or whatever, our main financing instrument, the RGB format, will be suffer in liquidity. And that's the reason why we only took the decision to go for a two-pillar strategy, the conventional one and the green one.
I think, I think that's a very critical issue for the high-grade sovereigns like Austria. I think liquidity is a key characteristic of government bond markets. And whereas it's interesting to slice and dice the amount of issuance you do by so many different types of instruments, I think first and foremost, for Austria, whose funding requirement is not as large as we would like it to be, it's important to preserve liquidity, and therefore I think you can't have too many different types of instruments in the issuance mix. But I think we've seen SLBs to great effect, particularly in Latin America, and it has really served as a very strong instrument to highlight to all stakeholders the commitment of Latin American sovereigns to the transition. I mean, maybe Camilla would comment further on how you've seen the LATAM sovereigns, but I think that they've really become synonymous with the growth of the SLB market and extremely committed there, from Chile and Uruguay and others.
Thanks, Philip. Did you want to come in there, Camilla? Yeah, it is. I mean, the space and the sovereigns within Latin America, that's a hugely important part of the market.
Yeah, and we have also seen how many countries, not only Chile and Uruguay, but also Colombia, has started to tap into this instrument with positive results and returns as well.
Caroline, I'm just going to bring you in here. Is there any kind of pricing debate around SLBs? You do a lot of the work that Client Bonds does on pricing. Is there any word on the street of how SLBs are pricing?
Hi there, thanks Bridget. Yeah, we've done 2 small studies on SLB pricing as part of our green bond pricing in the primary market research series. And in both cases, we found evidence of SLBs coming inside their conventional yield curves, i.e. Achieving a greenium. It's hard to assess the whole market because SLBs are often coming from issuers who don't have a huge established presence in the debt markets. Hence, it can be difficult to build yield curves for a lot of those issuers. But for the ones that we've done, we've definitely seen some very interesting pricing results, and we are going to be doing much more extensive research on this in the coming 3 months, which we will publish in September of this year. And one of the questions that we're going to be asking issuers is who is buying your SLB, because what we want to know is, or what we would like to know more about is, what are the untapped sources of capital that could be supporting this market. So yeah, we are going to be doing more work on that in the coming months.
Caroline.
Yeah, I think I think overall, if the market is to really grow, we have to incentivize issuance, and issuers, as rates are rising, then cost savings become all the more important. And I think it would be interesting, to find a structure whereby the investor base is going to put some real monetary value on the options that are embedded within the step up and step downs of an SLB. But I think also fundamentally, if a fixed income investor is taking a credit decision to buy a certain corporate, it's because he's made his credit analysis. He believes that the outlook for the company is going to improve, and he believes that the credit spread for that issuer is going to tighten, and ESG is very much part of that. And I think the work that Climate Bonds is doing now to encourage people to think about resilience is part and parcel of this investment decision. And so I can understand why investors are somehow reluctant to give away the benefit that they see when issuers start to perform, because they have a resilient business model, because they have achieved the climate goals, because they are transitioning towards a Paris trajectory. I think there are going to be ESG winners and losers in every sector, and every fixed income investor wants to back those winners. And they don't necessarily want to give away, they have a fiduciary responsibility to act on behalf of their asset owners, and they want the asset owners to benefit from that improvement. So it's a challenge, but I think everybody agrees it's an instrument which is perhaps ideally suited to the label transition. And if we talk about the overall volume of issuance, I mean, the sector of the market which is smaller than SLBs are bonds labeled as transition. And I think it would be tremendous for the market. We've talked about, 22 will be the year of transition, then 23 will be the year of transition. We have to get on with it now. All the banks are committing to making our own commitments to net zero. We can only get there if our clients transition with us. So I think for some sort of acceptance everywhere of the importance of transition and the roles that SLPs have to play in the understanding of what transition means and how that can fit into fixed income portfolios.
Yeah, and I think that's been key, thinking about, as you say, the transition. One of the challenges with the use of proceeds format is there was a lot of degree of discomfort labeling something transition, a hard to abate sector, doing something very small, potentially green with one hand, but the rest of the business doing something that investors were less comfortable with, which is, I think, why we've moved into this broader format where the whole company's on the line. Really, and that's the kind of key direction of travel that we've seen, which is why, as a transition use of proceeds format, I'm not so sure if we will see a huge amount of growth. I mean, I may be wrong, but I think there's much more appetite to see how, what the whole company is doing. And yes, there's, as we've said, a huge number of teething challenges with that, and it's difficult. This session wasn't meant to be about an SLB webinar, but I am glad we have spent a bit of time digging into this, because it is something people are very keen on understanding and knowing a little bit more about. So maybe I'll just, one more question, which is coming out of the chat, and we've been trying as much as possible to touch on some of these, is about post-issuance verification and the role of that within SLB. So the question is really about, a lot of the use of proceeds format didn't have this need for after the point of issuance annual reporting. Some of them did do this as a matter of course, but not all of them. Whereas in SLBs, that's more common. So have we got, any views among the panel of, if this will help increase the legitimacy and credibility of particularly SLBs? Will this reduce investor concerns? I don't know, Camilla, if you have a view on this.
Yeah, I think that the post-issuance phase is also fundamental to have a better and clear outcome of what is happening with the SLB. I think here there has been an important engagement from the investors with issuers to encourage greater transparency and accountability around all these SLB and transition theme bonds. This can include, for example, dialogue around reporting requirements, around verification, and around other issues related to sustainable finance. From an investor perspective, like Green, having a clear post-issuance reporting and clear impact of what have done, it's fundamental to trust the process and to drive a positive change in the market.
All right, so we have some solutions coming up. We have better guidance and better standards coming through. We have better reporting as well, and a lot of that, case studies as we go. And there was, also questions around how this improves over time. And I think it is a lot of learning by doing. And I think that's the last few years' experience on that has been critical. And the reporting is essential to that as well. There are a few more questions in the chat around SLBs, but I might touch on a different topic for a moment. Maybe if we have time, we'll come back to that, although I know we are running out of time. I'd like to think a little bit more about some of the other themes in the report and that Caroline raised, and particularly kind of two that sit quite closely together. And the one is thinking about adaptation and resilience and the growth of this market. There's a huge potential for this, and particularly within emerging markets. I've had a lot of discussions with emerging markets about mitigation, but it's not credible to come to the table to talk about mitigation when you're not, to a low emitting country and in a lot of emerging markets, without also talking about adaptation and resilience. These two things are two sides of the same coin, and we have to talk about them both. But we've seen very little deals, to date, and there's probably many reasons for this. And then linked to this, I guess, is also the social theme. To be a resilient society has also social implications, and also makes us socially resilient. So I'm not so sure who wants to start, but perhaps, Camilla, you're on my screen right in front of you, if you have any thoughts about this resilience market and the social themes as well, and how we increase volumes from this market and channel finance in that direction.
Yeah, absolutely. Maybe I jump first to the social part. I think the social insurance is certainly a positive development for the sustainable finance market, and it's following some of the main challenges we have also discussed on SLBs and transition bonds. There is quite of, there's like, also like lack of clear guidance and standardization around what constitutes social financing. And it's a concern both for issuers and for investors. On the one hand, for issuers, the lack of clear guidance can make it more difficult to design and market a social financing instrument. Without a clear understanding of what qualifies as social financing, issuers may struggle to attract the right investor and demonstrate the impact of financing activities. And on the other hand, also for investors, the lack of clear guidance can make it more difficult to evaluate the social impact of different financing instruments. So, for example, without a clear taxonomy for social financing, investors may struggle to distinguish between instruments that are like properly supporting social outcomes. What I have seen is that to overcome this challenge, issuers and investors are working, so it's a work in progress, together to develop more robust social taxonomies and other guidance around what constitutes social financing. For example, industry bodies such as ICMA, the International Capital Market Association, and the LMA, the Loan Market Association, have been developing guidelines for social and sustainability bonds that aim to provide greater clarity and standardization around these instruments. The ICMA, for example, has developed the social bond principle and the sustainability bond guidelines. And similarly, the LMA has developed the sustainability loan principle, which provide like more guidance for issuers and lenders on how to structure and document the sustainability linked loans. What I have seen also is that, or as far as my understanding, is that there has been also some progress on developing social taxonomies in recent years, although this remains a relatively nascent area compared to the environmental taxonomies. The goal here is to create a common language and classification system that can be used by investors, by issuers, by regulators to promote greater transparency and accountability. And overall, I think that with the lack of clear guidance around this social financing, it's a concern for issuers and investors, but my perspective is that there are like steps that are being taken to overcome this challenge. And I feel we can follow the same explanation for adaptation and resilience bonds. They are nascent areas. There's a lot of work to be done jointly with the different stakeholders in the market, but I'm very positive that we will all together find a clear way to follow on this path.
Thanks, Camilla. And I know we've only got a little bit of time left, but I don't know, Marcus or Philip, if you wanted to comment on this kind of area as well around resilience and social issues from an issuer and also from your perspective, Philip.
I mean, I don't want to put words in Marcus's mouth, but I think every Austrian government bond is a social bond in a sense that governments are there to do social good. And so anyway, I think it is interesting. There are different types of social bonds really took off with the pandemic. And we clearly saw an investor interest in supporting pandemic response. We did the largest ever transaction from the African Development Bank because it was a pandemic response bond. The largest ever World Bank global dollar bond, it was a pandemic response bond. So pandemic response was clearly, it captured the imagination of a lot of investors. And many public sector funds around the world were really motivated to help each other in support of the response to the pandemic. So I think we brought new portfolios into this label. And so I think that was in itself tremendous. The support we had for the EU SURE program, which was, due to the huge unemployment problems and this, the furloughing problems that governments had to deal with. So there's tremendous investor support, I think, for the pandemic response. Citi is the biggest issuer of private sector social bonds. We're the biggest private sector issuer of social bonds. We have two programs, one for affordable housing in the US, where we're the biggest lender to affordable housing, and one for microfinance lending in emerging markets. And again, it's interesting just how widespread the investor support is for affordable housing in the United States. I think social needs are something that appeals to every investor at a certain level. We don't need a particular portfolio to be driven by climate change. It's everybody wants to do social good. So I think there is everywhere a support and a sympathy for doing good and an interest in impact. I think with regard to emerging markets, then it becomes more challenging. And if we talk about social taxonomies, there was an interesting question on the chat here about the role of blended finance. I certainly think that can help. And I think, I don't want to go back to the SLB structure, but I think the technical assistance can help a lot of emerging market issuers come to these markets. But I also find with many of the emerging market projects that we work on within the formal labeled social bond market, we find many of the external second party opinion providers are not terribly familiar with the context of social and in emerging market context of what social means. So you can't, free healthcare for all or free education for all, equal access to all is a social concept in the developed world, but in the emerging market world where governments do not provide these basic social goods, this is a private sector service. And we have to look at it in a different way. And I think we have to understand development finance in a way that is not well understood and today, I would say. So I definitely think that social has a very big role to play, and maybe it's going to, but if we're going to help emerging market economies adapt through adaptation and resilience, I do think that blended finance is going to help in some way if we can reward policy making for making the right the right decisions, the right policy decisions.
Marcus, did you want to come in on any of your thoughts, and then I'll do a quick round of closing comments.
Yes, please. You mentioned the word liquidity. So it is very important on the one hand for the investors, but as well for the issuers. And if you look at the public entity level, you have different layers. You have the federal state, you have the sub-sovereigns, you have the municipalities. So therefore, from an Austrian perspective, we think for a project to include these different layers in one framework, then you have all the different projects from the different layers in one framework. You have therefore clearly higher eligible expenditures from a public entity sector perspective. So you can go for higher volumes in the transaction, different points on the curve. And that was mentioned with the innovative framework from Austria. It's a holistic framework from an instrument perspective, but it's not a holistic framework from an entity provider perspective. At the moment, only the federal states expenditures included in our holistic framework, where we now introduce to the market this green treasury bills, green commercial papers, green deposits on the short term, and as well on the long term, the bonds, but not only in the 15-year plus horizon, especially after yesterday's transaction with the 6-year. So we try to be really a reliable, consistent issuer, and this should bring a further demand to this market. And if you have from the supply side higher volumes, it's perfect then. Our framework at the moment from a federal state's perspective only includes 5.5 billion, and Austria's if you count it on a proportion to the GDP, is with 1.2%, the highest share from the sovereign area. But if we would include the sub-sovereign areas, roughly to our calculation, we would end up this year already with more than 10 billion. And it's at the amount from France. And if you compare the two economies, completely differentiation there. So I think we have to step further with aligning more from the supply side within one framework if it's possible. We do it in Austria with this on-lending facility already at the conventional products, but not on the framework products. We were not brave enough to include all the sub-sovereigns, the ministries in our inaugural framework. But there is a clear project to speak with all them to have it in one framework.
Yeah, very much so. And liquidity is a big part of the work that we have been doing. You know, that's a really key part of the market, and scale. We have reached time, but I would like to have a quick fire round of what next from each of you, maybe a 30 seconds of what we expect to see in this year and what the kind of future looks like. Camilla, maybe I'll start with you.
Thank you. Also for Latin American region and the Caribbean, I think there's a need to continue raising awareness around all these topics. In emerging markets, it's quite new instrument, with the exception of some countries like Mexico, Chile, or Colombia. So I think it's a continuous learning process, and different issues around different countries on a punctual aspects also. And hopefully we can see also a transition to more SLB social and other themes, bonds, more than green.
Thank you. Caroline?
Well, just to reiterate the point that Vivek made in his introduction, we have plenty of capital wanting to invest in thematic products. So I would say if you are an issuer coming to the market, if you haven't issued a green bond yet, issue a green bond. If you have not prepared your transition plan yet, prepare your transition plan. And once you've got that in place, then you are well positioned to come to the market with a sustainability linked bond. There is more than enough capital to absorb this kind of debt. There are investors with dedicated funds, and you know, our latest research proved that 67% of green bonds were placed with dedicated green or sustainability investors. So please consider coming to the market. That is my closing remark.
Thanks, Caroline. Marcus?
Yes, some short information from our side. I mentioned already Austria will have 5.5 billion for this year. On the volume side, we did the 3 billion yesterday. There is the clear plan to tap the existing, the inaugural bond from last year for the 2049 by 1 billion, and to continue with all the T-bills and the commercial paper and the deposit transactions, and to bring more liquidity in here. And we will publish by end of June our inaugural allocation report, and as well the impact report, because we decided to go for a combined report to the effect, if you invest in a 3 months T-bill, you should not want to wait the next 21 months for all the figures regarding the impact of your investment. So that's the plan on the short-term horizon.
Thank you. Philip, you have the last word.
Blimey, I wasn't really prepared for this question, but I think there's so much to hope for in the year to come. But I think investor focus on impact. Somebody said in the chat that, you know, pandemic is an emergency, and it was understood to be an emergency, and it mobilized huge amounts of capital. So I think a growing acknowledgement and recognition that climate is also an emergency. Let's all get involved and support the green bonds which are coming. And, you know, I would like to see further issuance coming from emerging markets, coming from developing markets. And it's going to be a challenging year with rising interest rates for those in emerging markets. And so let's hope that this is also a year where we can really start to see some blended finance transactions coming in on scale. I also think that we're going to see some interesting developments this year with regard to carbon pricing. I think this is also going to be an interesting component of the market. We are, you know, very interested to see the development of the voluntary offset market and carbon pricing more broadly.
Wow, opening up that can of worms with only seconds to go is a brave step. No, but thank you very much. No, it's a big topic of discussion at Client Bonds as well, and unfortunately we don't have time to get into it now. Although I would love a discussion on that, but you'll have to listen to one of our upcoming webinars on discussions on that. Thank you so much to all our panelists for joining us. Camilla, Marcus, Philip, Caroline, it's been an absolute pleasure speaking to you. I'm sorry to everybody's questions we weren't able to get to. I just got a message from my colleague saying he's very happy to answer some of them on LinkedIn and via email and that sort of thing. So we'll be trying to answer some of those questions as much as possible. This comes to the end of the webinar part of what we're doing today and this State of the Market presentation. We do have our 8th annual Climate Bonds Awards coming up, where we look at some of the deals and some of the issuers and some of the trends and present awards to some of them. So we do have that coming up, which you're most welcome to stay on for. And I will bid adieu to our panelists and hand over to Barney for the awards.
Thank you very much.
Thank you so much.
Thank you. All the best.
Thank you.
Welcome to the 8th Annual Climate Bond Awards. As you know, we have an extraordinary challenge. We have to reduce global emissions by 50% by 2030 to avoid catastrophic climate change. I mean, we've got climate change. We're now in a race to stop the worst. We need leaders. We need organisations that are shifting their assets, shifting the capital investment pipelines, becoming green. And today we recognise leaders in green bond issuance around the world, amongst corporates, amongst banks, amongst countries.
And this brings us to our purpose. At Climate Bonds, we work hand in hand with policymakers, investors, and issuers to secure $5 trillion by 2025 for climate solutions that will enable us to reach net zero by 2050. This is a challenging undertaking, but it is possible. Since our inception in 2011, we've worked with thousands of people in hundreds of organizations, all working to strengthen the movement and secure a sustainable future. The Climate Bond Awards celebrate the champions. In the last 7 years, we've acknowledged 211 organizations, such as governments, multilateral initiatives, and development banks, for their groundbreaking issuances in their respective countries. These efforts have significantly contributed to sustainable infrastructure, agriculture, and industry transition.
We have 34 awards we're presenting today. That's 34 leading issuers of green bonds for climate change activities around the world, in every market, every geography, every type of issuer. It's amazing.
Without further ado, it is an honor to announce the winners of the 8th Climate Bonds Awards.
The first award today goes to the largest green bond issuer of the year, the European Union, issued by the European Commission on behalf of the European Union. The second award, the largest development bank green bond, and also the joint winner of the largest sustainability bond, goes to the development bank that started this whole thing off so many years ago, 15 years ago, the European Investment Bank, still a leader in this space. And then the third award today, because it's linked to this one, is the largest issuer of sustainability bonds and the joint winner of the largest sustainability bond, International Bank for Reconstruction and Development, which is part of the World Bank. Over to you, Claire.
Thanks, John. The largest financial corporate green bond award goes to the Bank of China. The largest non-financial corporate green bond award goes to Société du Grand Paris. The largest green asset-backed security issuer award goes to Ginnie Mae. And the largest US green municipal issuer award goes to New York Metropolitan Transportation Authority.
Next, joint winners of the largest green sovereign bond issued in the world in 2022. The Federal Republic of Germany and the Republic of Italy.
A brace of green sovereigns. This year, the Sovereign Green Bond Pioneer Award goes to the Government of Canada, the Republic of Singapore, the Government of New Zealand, the Government of Switzerland, the Kingdom of Denmark, and the Republic of Austria.
The largest green sukuk issuance, a green sukuk is an Islamic bond, is the Republic of Indonesia that started this whole process of issuing green sukuk many years ago and continues to be a substantial issuer. As well as that, 3 awards for certified climate bonds. The Dominican Republic Green Bond Pioneer is the Empresa Generadora de Electricidad Jaina, that brought to market the first green bond in the Dominican Republic. The largest certified climate bond was the China Development Bank, a huge program they've got. And the largest certified sovereign climate bond was the Netherlands State Treasury Agency.
We have a 3-way tie for largest financial corporate sustainability bond. The awards go to Bank of America, KB Capital, and Wells Fargo.
The largest sustainability-linked bond, a new kind of issuance in the sovereign space, was the Republic of Chile, of their groundbreaking issuance in this area.
The largest sovereign, social and sustainability bond award goes to the Government of Mexico. The largest issuer of social bonds award goes to Caisse d'amortissement de la dette sociale. The largest financial corporate social bond award goes to Citigroup. And the largest social bond award goes to the European Union's Sure Bond.
The Sovereign Social and Sustainability Bond Pioneer Awards go to the Republic of the Philippines and the Principality of Andorra, that both issued the first ones in those markets. Andorra, isn't it fantastic that even countries like Andorra are issued in this space? And then finally, in the sustainability area, the largest US social sustainability municipal bond went to the Commonwealth of Massachusetts, who, by the way, was also the first issuer of a green municipal bond in the US many years ago.
The largest verifier for certified climate bonds award goes to Morningstar Sustainalytics. The largest external review provider in number of deals award goes to Cicero Shades of Green, now a part of S&P Global.